Our headline today comes to us from Saul-Sehy, and it is about a topic that we haven't covered here before. And frankly, the reason that we're covering this is we noticed that a lot of people that subscribe to our YouTube channel, this is one of the top things that they search, which is, it's called crypto arbitrage. And the piece today is written by Colin Dodds, crypto arbitrage, how it works, and trading strategies.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
So to start off, let's go over what cryptocurrency arbitrage is. What's happening here, is that people have noticed that when it comes to crypto versus stocks, traders aren't paying attention to fees. In fact, we've done stories about this in the past where these people that are super analytical about the fee that they pay for a trade on a stock or an exchange traded fund, all of a sudden when it came to crypto, remember the wonder years of crypto? Like, I don't care what the fee is, I'm in. It doesn't matter. Right. And they're trading at these exorbitant
Well, this was
fees.
happening at Robinhood, right? Where you weren't getting a really good execution price.
Yeah.
But you got to do it for free. So,
well, and that's exactly it. You can even take Robinhood as an example here because the execution price changes from exchange to exchange. So what some traders noticed is, hey, I can buy crypto X. Let's just say that it's Litecoin. I can buy Litecoin on exchange X, take it off that exchange, move it to a different exchange where the price is higher, and sell it for a higher price. So these people are making a guaranteed, maybe 10, 20, 30 cents a trade, or maybe $1 a trade, maybe $2 a trade, but they're just making money on the difference between exchange A and exchange B. Now, what's interesting about this is I remember taking my Series 7 back in the early 1990s. This was a thing. I remember our instructor getting all excited about this and talking about arbitrage, where people would buy General Electric stock on the New York Stock Exchange, then they go sell it on the DAX, the German exchange, right? Or they take all these different exchanges, look at the price, and then they make a guaranteed 10 cents or 15 cents and trade as many as possible, as quickly as possible. So they make these quick guaranteed returns. Not a lot of money, per deal, but if they do enough deals, it ends up being a big deal. You know what's funny about those? Those all went away. And the reason they went away, this idea of arbitrage, is these high-speed computers made that go away. That's gotta be, if crypto manages to stay around, that's gotta be, what's going to happen here, I would imagine.
I can't imagine it's already not happening, right? I mean, you'd have to think that in the information age that we have, where just about every known thing is known to every person immediately, right? There's no secrets when it comes to investing. There's no secrets when it comes to, this arbitrage thing. If all of a sudden one exchange has got a price different, everyone knows that information immediately. And it wouldn't take a programmer very long to be able to build a program to be able to take advantage of that, I would think.
There are three different types of arbitrage. There's spatial arbitrage, which is the one that I just mentioned. Spatial arbitrage without transferring. The piece says some traders try to avoid the risk of transfer cost and times that spatial arbitrage poses. For example, in a hypothetical case, they may go long Bitcoin on one exchange and short on another, wait until the prices on the two exchanges converge, and then boom, which they do. The time, to your point, between those convergences happen at shorter and shorter intervals now. So just notice it, hold it, sell it, boom, I'm done. And then third is triangular.
What happens if Bitcoin all goes down by like 70%? See, you make 30 cents, you lose $10, but you make it up on volume the more often you do that. All right, got it.
Yes, you got to understand how this works.
Got to understand how this works.
And then triangular arbitrage takes advantage of pricing and efficiencies using different pairs of cryptocurrencies on the same exchange. So with this strategy, they'll start with one crypto, trade it for another crypto in that same exchange, one of which is undervalued versus the first. So they're looking at crypto A versus crypto B, a little bit more intensive. But overall, for the majority of our listeners, majority people watching our YouTube videos who are searching this stuff on YouTube, this is a strategy we should be employing.
I mean, I can't imagine that this makes sense for hardly anyone, unless you're one of those people that have just tons of volume to be able to move. You know, we talk about this a little bit when it comes to like your savings accounts, right? It's like, hey, should I move from bank A to bank B because bank B is paying me 0.1% more? It's like, well, do you have $10 million? Because there's an awful lot of paperwork to open a new bank and move the money, and it's out, you know, you got to do all that crap. And no offense, but your $10,000 on 0.1 is going to make you an extra $10. I mean, $10 is something, but is it worth all of that energy and effort to, you know, to do that? I'm not sure. So if you've got, you know, $80 in your crypto account, you're going to arbitrage it at a penny per, you know, I mean, okay, it's probably not going to be successul in the manner in which you think it might be.
And that's the question, right? Is what is the opportunity here? And I wanted to look into that. So this comes to us from MoneyWeb. This is written by Sierra and Ryan. Has crypto arbitrage bounced back? So looking at this, it says it's been a painful few months for those doing arbitrage. It's been a painful few months for anybody doing crypto, period.
If you've been sitting in cash, it's been okay, but otherwise it's been painful for everybody.
These arbitrage spreads, it says, have narrowed to less than 1%. But then came the implosion of crypto exchange FTX a few weeks ago and a sudden strengthening in the rand. This is a South African piece, obviously. In the blink of an eye, the crypto arbitrage market bounced back to life with spreads widening to about 3.8% 2 weeks ago and hovering around 3%. So you're looking at a locked in 3%, which is nothing to sneeze at, OG. If you're using large amounts of money, like locking in a guaranteed 3 is not bad. However, to your point, how much money are you going to need to devote to a strategy that could be used making significantly higher returns?
I get it. I can make $3 every time I move 100. I just have to move the 100 a whole bunch of times. And if I do that, you know, twice a day, that's way more than I'm going to make, you know, investing in my ETF. Sure. Until the one time that it doesn't work. Usually when there's the one side that has the wild return potential, there has to be some sort of offsetting downside exposure as well. There's just no such thing as the free lunch. And so I got to imagine that there's also a timing element involved in here where you kind of got to be lucky. Like the author was saying, it was great until it stopped being great. And, you know, if you happen to have that week off from your arbitrage strategy, you know, you're like, oh, phew, dodged that bullet, you know. But what happens if you weren't? What happens if you got caught holding all of this stuff because the spreads tightened and you're like, I'll hold on to it for a quick minute just to see if it, and then it never did, and then it went down 70%. It's like, how many 3% trades did you have to do? You know what I mean?
That's a lot of trades. And even though it's a guaranteed 3% today, to your point, you got to be lucky with that timing. I mean, a week ago being 0.7, 0.8, you know, significantly lower returns, less than a third return on that. This idea of arbitrage, I think, may be easier in some other platforms. I know people that do that do as a job. Maybe we should have these people on. They're the flea market flippers, and they actually go to flea markets and they know what these things are really worth online. And they will pick up things at estate sales and flea markets, and then they will resell them online for a ton more. That OG is arbitrage. There's a little, you know, there's postage and mailing the stuff out, but that's arbitrage right there.
I've seen videos of Gary Vaynerchuk doing that with little toy cars.
Really?
Like he goes to garage sales and buys, like, you know, you get the little Matchbox cars or whatever. And he'll be like, I'll just take them all. How much do you want for all of them? The guy's like, I don't know, $20. He's like, all right, cool. Here's 20. And he takes, you know, 700 cars and he thumbs through them and goes, this is the one I wanted, you know?
And there it was.
But the difference is that you have something in that example, you know? I mean, it may be $20 worth of toy cars.
Sure.
If you don't have the one that you want, you have $20 worth of toy cars. And also the opportunity cost is really low. You know, I don't see the same thing being true for, you know, buying Bitcoin.
Agreed. For anyone interested in these topics and wants to dive into them more against my better judgment, OG, we'll put it in our free newsletter, the 201, stackingbenjamins.com/201. And Brooke Miller will link to all of these topics and also to the flea market flipping, which I think is also an interesting opportunity for somebody. Estate sales going on all the time. Undervalued objects in your backyard. Maybe an easier way to make money.
If you know what you're looking for, sure.
If you know what you're looking for.
I think that's the key too. I think with those folks is they're experts in a few things. You know what I mean? They're not just blindly walking into like, oh, look, a table. You know, they know
Tables.
They know tables. Or, I've read those stories about people that, go to a yard sale or whatever and find a rare painting or something. It's because they know paintings. They didn't look at the lighthouse and go, oh, that's a nice lighthouse, I'll take that. They went, oh my gosh, I think that's a whatever. And it's because that's what they know. 100 other people walked past the lighthouse painting and went, I don't need a lighthouse.